Hey everyone, welcome in to another daily editorial here on the KE Report, chatting with Jeff Christian. We're going to be talking Fed rate cuts and the trickle-down impacts to the economy, precious metals, and even inflation. Where inflation could be going from here is undoubtedly we are going to get a series of rate cuts out of the Fed. We'll also talk a little bit about investment demand for precious metals. Jeff is the managing partner at the CPM Group. I'll post a link to the CPM Group website in the show notes. Jeff, we got the first of a long anticipated rate cut from the Fed. It was 50 basis points, more than really what was expected. It was a coin flip between 25 and 50 basis points. Fed went higher, and the markets reacted, especially the day after. Everything moved higher. Now that we've had a little bit of time to think about it, let's forward project what these rate cuts mean, starting off with the underlying economy in the U.S. Jeff, your take on this, please.
Well, I think the rate cut is good for the U.S. economy. Lower interest rates, lower interest payments, that's good for the economy. It's good for consumers and businesses and the government. And it's also good for precious metals and financial markets because it lowers the competitive nature of investing in interest-bearing assets. So it's good for the economy. There's the actual rate cut, but the size of the rate cut and the timing suggests that there are reasons to be concerned. We've said it for a year and a half or so when people were wishing and praying for lower interest rates. We were saying, first off, you have to understand the Fed will only lower interest rates when they are seriously concerned about economic growth prospects in the U.S. economy. And for them to come along in September and do a 50 basis point cut says they are concerned. And even though Jerome Powell stood there and said, we think the economy is strong, but this is a good time to cut rates 50%. That's like, it doesn't add up. The fact that the Fed felt that it was time to cut and to cut by 50 basis points tells us that the Fed, looking down the road, is concerned about some of the economic trends. We are in the late stages of an economic expansion. The economy is maturing. There are supply stresses showing up in some sectors of the economy. You still have pressure on the costs of medical and transportation services. You have investors and corporations sort of slowing down their spending and their borrowing. So you're seeing signs of a maturing economy that is either maturing or could slide into a recession. So I think the fact that the Fed did it, the interest rate cut is good. The fact that the Fed did it provides some cause for concern about what the economy is likely to experience over the next 12 months. So that's sort of my headline take on it.
Yeah, good point, Jeff. They don't usually cut if things are rosy under the surface, so it could mean some economic data is concerning them. What about how that affects the currencies? Because we've seen a move down in the dollar. Could it exacerbate the move down in the dollar? And could that also rekindle the yen carry trade unwinding because that would mean the yen's appreciating versus the dollar?
It's hard to say what's going to happen. My own take is that other central banks will take the cut by the Fed as an opportunity to cut their own rates. We've seen China cut some of its rates this week. So that I think that beyond a week or two, the effects on currency exchange rates may dissipate. And what we're seeing, despite what some gold bugs say, is there still is a strong interest in U.S. dollars and U.S. treasuries on the part of foreign central banks and governments, as well as overseas investors. So we're still seeing strong demand for the dollar. And that reflects partly concern about other currencies and other governments and other economies, but it also reflects interest in investing in the broader U.S. equity market, obviously investing in treasuries, and also investing in businesses and real estate in the United States on the part of foreign investors. All of which sort of suggests that the dollar still has a lot of reasons to remain strong, which is what it has been doing.
So, Jeff, as much as we're just talking about the Fed rate cut, other central banks have been cutting rates. The Fed almost did, it seems like, this 50 basis point cut to catch up to some of the other central banks. Any other central banks out there that have your attention that you think we need to understand the bigger picture here, where it's central banks really around the world that are lowering rates?
It really is around the world, and there's not one particular one. Obviously, the United States Treasury is the most important one. The secondary one is the ECB and European monetary authorities. And then China is probably the third most important one. And then you have Japan, the UK, Australia, India. And as you said, most of these central banks are cutting rates. And in fact, if you look at the U.S. two-year Treasury, it's been declining for several weeks already, interest rates on the two-year Treasury, in anticipation, well, partly in anticipation of a Fed funds rate cut, but also reflecting what I was saying earlier, which is that corporations and individuals are kind of topping out in their investable and spendable disposable income. So you're sort of seeing a topping out in the economy. And I think it's a global thing. And that's one of the reasons why we are probably more sanguine on the US dollar than others, is that what you're seeing is this gathering weakness is global. We're also sanguine on the dollar compared to others because others seem to hate the dollar and have been predicting their entire adult lives that the dollar is about to collapse. And, you know, someday maybe they'll be right if they live that long.
Well, Jeff, let's also bring in the inflation picture, because the rationale for the rate hikes over the last 2 years was, in the tighter monetary policy, was to squash inflation, and inflation has come down. The concern now from economists is, what if cutting rates starts spiking the inflation punch bowl? What are your thoughts on that?
Well, you look at the components, what causes inflation, and what are the components of the inflation factors in the United States. You know, the first thing that causes inflation is imbalances between the supply and demand of goods and services in the real economy. And there are some issues there that I'll come back to. The second thing is fiscal policy. And while we still have a very stimulative fiscal policy in the United States and in the Eurozone and other places, it is half as excessive as it used to be. So you have seen fiscal constraints reducing the inflationary pressures. But to figure out what happens with lower interest rates on inflation, you have to look at where are the inflationary pressures in the economy right now, and what are the interest rate sensitive sectors of the economy. Now, right now, yeah, we've seen inflation's gone from 9% to like 3.2 with the CPI core or headline. And the inflationary pressures that remain are not the things that were stimulated by the fiscal largesse of 2020, 2021, when the U.S. government poured like $6.4 trillion. That was their cumulative fiscal deficit in 2020, 2021. That's been spent, and that's worked its way through the inflationary pressures. And insofar as inflation rates in total have come down, it reflects that money dissipating. But where we're seeing the inflationary pressures are primarily in the service provision for transportation and service provision for medical. Those are not particularly interest rate sensitive parts of the economy. So a lower interest rate doesn't necessarily stimulate output by those things, and it doesn't necessarily stimulate inflationary pressures in those sectors. Those are the worrisome sectors of the economy from an inflation perspective. What is sensitive to interest rates is housing and auto. And housing and auto are both suffering, but they're not so much, despite what you've read in the papers, high mortgage rates, high interest rates have been relatively minor in terms of what the problems are that the housing and the auto markets are facing. These are facing demographic changes, and they're facing imbalances between the supply and demand. Supply of large houses that have big margins that construction companies want to build, and the demand for starter homes and empty nester homes, smaller, more affordable homes. And, the government's just standing by and watching this and not really encouraging home builders to build the homes that home consumers want. So you've got some very big structural issues there, as well as the cost of housing. And a decline in the mortgage rates will help some, but it won't deal with those really big issues that the housing market is suffering from. And similar dynamics exist in the auto market. The auto market has an imbalance between the large vehicles with large margins that the auto companies want to sell and the smaller vehicles that consumers want to buy, and the demographic changes in the consumer interest in owning cars with a reduction in car ownership, and surveys showing that more and more people don't necessarily see a desire to have a car or more cars than they already have. So you've got some demographic changes in the auto market. You have an imbalance between supply and demand. You have increased costs. You had a couple UAW strikes and settlements with increases. You have the whole issue of the transition to electric vehicles, which is now sort of backing up on the auto industry because you're seeing increased consumer concerns and disinterest about owning electric vehicles. There are bigger issues that are problematic for the housing industry and the auto industry. And lower mortgage rates and lower interest rates are not going to solve or address those demographic issues and imbalances between supply and demand in both the housing and the auto markets. So our view is that interest rates will have a relatively small impact pushing inflation higher, but they probably will have a similarly small impact in staving off further weakness in the economy going forward.
All right, Jeff, let's focus on the commodity sector then, because on the back of that rate cut, boy, oh boy, all commodities did well. Gold continues to hit all-time highs, seemingly on a daily basis. Copper's bounced strongly off that $4 level. Silver's even up easily above $30 right now. From an investment angle, have you noticed any significant changes in investment demand for any of the commodities?
Well, yeah, you've seen increased demand for gold and silver, really globally. The cut in interest rates and the anticipation of the cut in interest rates has helped, but I think that many precious metals investors are paying more attention to domestic politics, either in the United States or in their own countries, all of which are problematic, it seems, and international political factors, and the overall growth rate in the economies. I think that the interest rate cuts were helpful to stimulating and keeping investors interested in gold and silver. It helps reaffirm the views that have been supporting that demand, but I don't know that it's the major factor. I will say this, I keep hearing people talk about how North American investors haven't really participated in the run-up in gold purchases and prices. And I haven't seen that. I've seen a healthy increase in gold demand from North American investors, ranging from retail investors to high net worth individuals to institutional investors. I haven't seen these guys standing aside from the gold market or the silver market. I have seen them standing aside from the mining sector, but that's another issue there. In terms of the interest in gold and silver, I haven't seen the disinterest that other people say that they're seeing. So I'm not quite sure where they're getting their insights.
Well, Jeff, just as we look at gold today, at the time of this recording, it's hitting new all-time highs on the futures contracts. But I guess a lot of people wonder, with so many elements already priced in, the rate cuts people have been looking forward to those for about a year and a half now. The geopolitics has been constant, but people have gotten kind of used to it. And there has been a lot of central bank buying, and there has been buying in the East and the West, as you point out. But what is it that would propel gold to 3,000? We hear all these calls about $3,000 gold. What do you think the fundamental drivers for a move like that would be? Or do you think we're getting top heavy here?
Well, I think we are getting top heavy. I can't rule out, I haven't ruled out the idea that the price could spike to $3,000. I don't think it would stay there. Frankly, I think that may be a little bit too high, but I could see a spike in gold and silver prices in the next 7 months, probably primarily stimulated by a combination of international political developments, domestic political developments, and economic factors.
All right, Jeff, all good things for us to consider. Look, there's a lot of bad things going on around the world right now. They've been going on for years, some of these things. It's all playing into, I think, a stronger precious metals market. Lots going into stronger precious metals markets. Markets are continuing to do fairly well, but a lot of people still waiting for a more severe market pullback, market correction, and who knows, maybe a recession now being called for early next year. We'll see how it all plays out. But Jeff, I do appreciate you taking time and sharing some of your insights on the precious metals markets, the economy, and what we could be seeing in inflation data. Again, Jeff Christian, managing partner at the CPM Group. Click the link in the show notes to learn more about the CPM Group. Jeff, thanks for your time today.
Always a pleasure.